If you invested $10,000 in the market a year ago, you probably feel hesitant about putting more money into that market. But here's why you should invest another $10,000 in the market today. In fact, yesterday. Welcome to another edition of the McEnulty Method. I'm your host, Bill Vashwick. We're joined by financial experts Frank McEnulty and Colin Sorrells. They're here to give you all the tools to build a successful financial future. Gentlemen, how you doing?
Great. How are you?
Doing well? Now, last week, you gave us some great insights on how young investors should feel about everything that happened into the stock market in 2022. And for our viewers, if you haven't checked that video out yet, I highly recommend you do so on YouTube channel at the McEnulty Method or the McEnulty Method or whatever platform you're currently listening to this on. But this week, we want to follow that discussion up by letting young investors know that despite all the recent events, they should continue to put money into the market. Frank, can you tell our listeners out there why they should continue to invest in the market?
I can, or at least I'll try. Well, as I alluded to last time, the market, quite honestly, I feel much better about putting money into the market now than I did at the end of 2021, because the market had gone up so much and valuations were getting so crazy that they weren't really supported by the economy. Remember, stock valuation is supposed to be supported by what the company can generate in income, net income that belongs to the shareholders. And they were just getting too high. We were printing money like mad. People had lots of money to put places. Interest rates were low, so no reason to put it in the bank. Hey, let's put it in the stock market. Let's drive up the price of stocks. Whereas now they've actually started to come down a lot more to where they're a reasonable price. And, we always talk about the stock market being a long-term thing. And that's really long-term. We're talking about the economy of the country and everything else. If you believe that the United States is going to be fine, that the economy is going to be fine, yes, there's hiccups. Just like a person gets a cold now and then and doesn't function at 100%. Same with economies. But overall, as long as you believe that the economy of the United States is going to continue to grow over time, then you want to continue to investing in that. But do we know when it's going to be really good versus when it's going to be really bad? No. And so the key is, and everybody talks about this, is what they call dollar cost averaging. You put the same amount of money in at the same time every month, every week, every year, however you want to do it, regardless of whether the stock market's down, it's up, you're just putting money in there to keep going. Because unless you're an expert, and even the experts don't get it right, how do you know when it's absolutely too high? How do you know when it's absolutely too low and it's going to go up? I don't. Colin, do you?
Yeah, no. I'd like to think so, but no, probably not.
Well, that's just it. We all want to think we're smarter
Exactly.
than the next person, right? We can figure it out. Got all these experts, but yeah, they don't know what they're talking about. We know better. But I've found over time, and I've read quite a few articles about this, that people who seem to be retiring with the most money in their retirement accounts and investment accounts and 401k accounts are just the people that, the day they started working full time is the day they started putting money away. They invested it in funds. They just let it sit. They didn't stress over it. They didn't pay attention to it that much. They checked every year, say, maybe I shouldn't be invested in, buggy whips anymore because they seem to be going away. Maybe we should get out of that fund, the buggy whip fund, and move into the electric car fund or something. Other than that, they don't do anything. And all of a sudden, they're 60 years old and they're staring at 4 million dollars in investment accounts because the economy just grew and they just kept putting money in it time after time after time. So it really be, if you can do that, it's really quite easy. And I know that's boring, right? Oh man, I want to play these things. I want to find the next Tesla. I want to find the next Apple, whatever. Great. So here's my advice. Take 10% of your money each year that you're going to invest and say, okay, this is going to be the money I'm going to lose because I'm going to chase all those brilliant ideas that I hear from my coworker, I hear on the radio, my barber's telling me, but it'll be fun, you know? And we can all spend money fun, but as long as you don't put 90% of your money in those things and 10% in your investments, you'll do really well. And yes, I know somebody's going to come and tell us that, well, I put all my money in Tesla when it was $20 a share and now I'm a multimillionaire. Good for you. Can you do it again? Everybody can get lucky once. Twice is not as easy. So, Colin, what?
Well, yeah, I just wanted to take a look at the sort of the graph we did, because I think you explained it beautifully about, you're talking about people who just time after time, same day, every month, like clockwork, here's my 100, 500, 1,000, whatever. Just putting the money away into some fund, 401k, whatever. And, they're coming away with, you say 3, 4, $5 million, and it sounds great. And I think it always brings up the question, people, why do we want to time the market? Why do we want to buy at the lowest point? I think because in our minds, there's this huge difference in what we're going to get back from, being able to time it, being able to buy at the bottom, as opposed to, just kind of having this set time and maybe it's near the bottom, maybe it's near the top, maybe it's somewhere in the middle. And, we did some research on that. And it's basically if you took, S&P 500 index fund, which pretty typical, for 10 years, the last 10 years, which it's been maybe the best 10-year period we've ever seen for stock market in the U.S. economy. And we basically had three cases. So if you invested on the worst day of the month, which means you basically bought at the absolute top each month, when you put that $1,000 in, you were getting the least amount of shares for your $1,000. Best day, which is the one everybody wants to be in, is when I'm getting the most shares for my $1,500, $100. And then just the 15th of the month, which is, Frank, to your point, the dollar cost average, just 15th, putting my 100 in and not thinking about it, just letting it go. And what we found, if you did that, I think we set it at a $500 a month, just a number, just to sort of something that maybe the average person could actually do, not realistic to say, I'm going to put 10,000 a month in. But, what we came out with, and the gap does widen when you start talking about putting 10,000 in and stuff. But if you just put 500 in every month, after 10 years, what we found was pretty much that the gap between buying on the worst day of the month and buying on the best day of the month was only about $5,000, which is, when you're talking about 100,000 is about 5%. And if all you did was invest on the 15th, and there were a couple times where, hey, the best day was the 15th, the worst day was the 15th. Sometimes it's closer to top, sometimes the bottom is right there in the middle. So really, if all you did was put your money in on the 15th of every month, you lost out on about 2% a gain. Now think about if you're a young investor and you don't want to be a full-time investor and you have, another career, think about the time you save, not having to try and figure out, well, what's going to be the next big company or what's going on in the world and all the news. You save time, and Frank, to your point, you save the sort of stress and of trying to be, I've got a 1 in 30 chance this month of getting the right day that this is going to be the lowest point of the month, and those odds aren't great. And then you start talking about trying to do that month after month after month. It's a much easier method, and you're really not losing that much return on your money.
Well, and you're not going to do it anyways, because
Exactly.
your assumption means that you have to pick the best day 120 times in a row. Okay. Once again, if you're that good, we're going to Vegas. We're going to Santa Anita horse track.
That's right. You can be my financial
Yeah,
advisor.
we'll go anywhere that your genius at picking the best and worst comes through. I think the point is not to worry about it. And how do you do it on the same day every month, basically? Well, if it's a payroll deduction, hey, every time you get paid, they take the money. I know with a lot of payroll deduction type things, you put it into the whatever account it goes into, and then you can have the funds already set up. So say, okay, well, 20% goes into this fund, 20 into that, 20 into that, 20 into that, 20. So it truly is brainless. It's the money goes in, it gets divided amongst these accounts. It goes in every Friday, every 2 weeks, once a month. Done. And as we've seen, if you never see the money, you don't know it's gone. If you have to get a paycheck and then write a check and transfer it, well, I'll do it Monday. Well, I forgot. Now it's the next paycheck. Okay, I got to do it twice. Well, shoot, I spent that money. Just have it put away every time. That's what makes people successful long-term investors, because you don't have the skills and the talent and the backing to analyze the market like Wall Street does. And even they get it wrong. They don't know what's going to happen tomorrow. We were down 600 points today. We're going to be up tomorrow. We're going to be down tomorrow.
That kind of raises another question. And, financial, investing advice is one thing, but when you put your whole financial life out there, like 2022, there's rents, there's your jobs. A lot of people were getting hired, a lot of people were getting fired. Did 2022 prove that you really should hire a financial advisor? That's something I would love you guys to take a look at on the next edition of the McEnulty Method.
We can do that.
All right. So we hope you will tune in next time and find out what they have to say about a financial advisor. And in the meantime, if you want to learn more, you can check out our YouTube channel at the McEnulty Method. Like I said, at YouTube or where you're currently watching this show. And guys, thank you very much. We will see you next time.